what is the potential risk to everyday investors?
Well, the risk to everyday investors, to start there, is that they don't know enough. By definition, these companies aren't reporting companies, so they may not know enough to really make intelligent investment decisions about these companies, and that's been a problem with some of these sorts of things in the past. Presumably, though, Nasdaq will issue its own rules and regulations saying how much information and disclosure is going to be required of these companies to list, and that may help solve that particular problem. Professor
Ritter, your general take on this, is it dangerous in any way for average investors?
Well, the devil's is in the details. Currently, Shares Post and Second Market are allowing trading for accredited investors in private companies. It's not clear whether the Nasdaq private market is changing anything, whether they're going to be allowing non-accredited investors to trade, whether they're going to have different required disclosure than the existing private markets have.
Okay, so I'd like to pick up on that point of accredited versus non-accredited. And right. Bob, just to remind everybody, accredited means you have $1 million in cash, not counting your home, right, that you are able to invest, $1 million or more.
Right, $1 million or more. Now, remember that Nasdaq doesn't get to change the rules about who gets to invest in these things. That's the SEC, and these are private placements. So it is going to be limited, unless there's another change in law, to accredited investors only. The interesting question there, I mean, it's a very reasonable question, though. What does it mean to have a listed private company? Because until at least the regulations under the Jobs Act become final, you can't even talk about these things. So you can't talk about them. There's no particular information about the company. So it's kind of unclear what this means at the moment.
Although, Bob, I would say, I mean, there's a lot of private companies, and you have contacts at numerous ones here in the city who, quite frankly, they're trying to keep their books as if they were a public company.
Oh, absolutely.
I mean, there's an internal discipline that suits them as well, but I guess it's just too difficult to trust that everybody has the same standards.
Well, right, but Nasdaq can enforce those standards in terms of disclosure. And what I think the longer term picture here is that this is where the world is going, for sure. There will be more liquidity in these early stage companies going forward. Investors in them will be able to swap the shares and take their tax losses at the end of the year. So this will help the startup ecosystem.
Professor Ritter, I'd like to bring you back in on this point. It's something that relates to what Bob was just saying. If a company has its books in order to be a publicly traded company, shouldn't that company just go public?
It all depends upon what's best for the company. Many companies, especially in the technology area, are choosing to sell out in a trade sale and never go public. So one issue is, should the company remain as an independent company, whether it's private or public, versus should it sell out to a bigger company in a trade sale?
Okay, so that's an interesting point. Bob, I want to bring in Facebook, right? Because we talked a lot when Facebook went public, and a lot of people said, public investors said, you know why this turned out so poorly for public investors is because Facebook was trading for 2 years on Shares Post, for 2 years on Second Market, other kinds of exchanges, and that's why public investors got hurt.
Right.
Is there something to extrapolate from this example, or was Facebook such a one-off just because of its size?
Well, there are several things to extrapolate from the example. One of the reasons that its share price ran up so much was the classic buy on the rumor, sell on the news sort of thing. The idea was, hey, I'm getting in on something that no one else can get in on, and when it goes public, it's going to pop like crazy. I'm going to make a fortune. So nobody paid attention to the underlying economics, which, by the way, largely they couldn't, because the information wasn't available to them. So I think that the lessons here are, again, you've got to have some real disclosure of these company financials before you make the investments. And if this becomes the normal standard way of doing things, then there's going to be less hype around getting in on something before the IPO and the big pop.
Professor Ritter, do you feel like those are the lessons learned from the Facebook example? Do you see it in a different way?
I think those are legitimate concerns, but on the other hand, Apple has fallen by 30% in the last 3 months. That has nothing to do with the failings of public markets. Facebook's value fell as well. I think it's a little too harsh to say that private market speculation was responsible for that fall. You know, any company could have a change in investor expectations that might result in the price increasing or decreasing, like Apple's has recently.
But Professor Ritter, from what I understand from the Facebook example, it was pretty much an example of what not to do from start to finish.
With the Facebook IPO, there were certainly several glitches. For instance, the first day delayed trading.
No, but even before that, I'm talking about
confirmations.
the pricing, the investment bankers, Goldman having the lead and such a strong lead, even far too much gray space between Goldman and Morgan Stanley and other participants. I'm even talking pre-market.
I'm not that critical. With 2020 hindsight, yes, there was too much optimism about Facebook's offer price, but this has happened with many other companies as well. I think the bigger problem is not private markets here, but it's the whole book building process where investors, institutional investors, don't have the right incentives along with investment banks in terms of trying to focus on long-term value rather than making a quick buck.
Bob, you have a comment there.
Look, there are a lot of good things about having some liquidity, even in private shares. No one would dispute that at all, certainly not me. One of the best things about it that's very important is that the employees in these companies tend to be young people, childbearing age, and if it's going to take a very long time to really go public, they need some ability to liquidate their shares and get cash to actually live their lives. So that's a big plus.